Big news out of the Indian stock market today. Welcome to the Explainer. I'm so glad you're here because we've got some major breaking news that is absolutely shaking up the financial landscape right now. We're talking about a massive shift in one of the world's most watched benchmark indices. So grab your focus and let's just jump right in.
So, here's the big question. Why is an absolute staple, a literal giant of Indian IT, getting booted from the top 50 to make room for a stock exchange operator? And honestly, what does this actually mean for your money? When a shift of this magnitude happens, the ripples are felt across the entire financial ecosystem. We're going to break down exactly how this works, the immediate market reaction, and the bigger picture for you.
Section 1. A Nifty 50 shakeup.
You really couldn't ask for a starker contrast here. On one hand, we've got BSE Limited, literally the company that operates the Bombay Stock Exchange itself. They are officially entering the Nifty 50. And on the other side, Wipro, one of India's biggest, most iconic IT companies. Yep, you heard that right. Wipro is stepping out of the Nifty 50. It's kind of wild, right? It's this striking visual of the old guard of the tech boom stepping aside for the actual infrastructure of the stock market itself.
Now mark your calendars for this one, September 30, 2026. That is the exact date this change takes effect. This isn't just some random, arbitrary swap, by the way. It's happening as part of the regular Nifty 50 index review. They're constantly evaluating the index to make sure it actually represents the market accurately, and this date is when this specific changing of the guard becomes official.
Section 2. Why is this happening?
Okay, so it really all boils down to one thing: free float market capitalization. That's the primary metric they use to figure out if a company's available market value is big enough to make the cut. It's strictly a numbers game, guys. Over the evaluation period, BSE's 6-month average free float market cap simply grew large enough to qualify. And unfortunately for Wipro, under the strict rules of the index, they became the smallest constituent. So yeah, it's just a game of relative size, and BSE quite literally outgrew Wipro's spot.
Section 3. The passive investing effect.
This whole situation is actually a perfect look at the hidden gears of institutional finance. Think about it. The Nifty 50 is tracked by a massive amount of passive investment money. So here's how it plays out. Step 1, a stock like BSE enters and Wipro leaves. Step 2, all those passive funds that exist purely to mirror the Nifty 50, they are essentially forced to adjust their holdings to match this new reality. It's algorithmic, they don't have a choice. Which leads to step 3, a huge domino effect. Funds have to buy the entering stock, creating immense buying pressure on BSE, and conversely, they have to dump the exiting stock, putting heavy selling pressure on Wipro right around the time of the change.
But look, the market is smart, right? Investors know this is coming, so they rarely wait for 2026 to actually react. Just look at the immediate market reaction today. BSE shares jumped around 4% on the news, while Wipro shares took a hit. The market is already pricing in that future buying and selling pressure almost immediately. It is a fascinating real-time example of how a simple index reshuffle can move billions of dollars in a single trading session.
Section 4. The bigger macro story.
Now let's zoom out a bit because this is the real takeaway here. BSE didn't just grow in a vacuum. It grew significantly for one specific reason. India's stock market and its entire domestic investing ecosystem are expanding at a truly massive rate. The fact that the operator of the stock exchange is now big enough to sit alongside the top 50 companies in the country, that is a direct reflection of this explosive growth in domestic financial participation.
On the flip side of that coin, we've got Wipro. And this really highlights the intense changing environment for traditional Indian IT companies. They are facing some serious headwinds right now. We're talking about the rapid rise of artificial intelligence, total shifts in global technology spending, and just immense pressure on those traditional IT service models that companies like Wipro were built on. It's literally a tale of two different sectors heading in totally different momentum directions.
Which brings us to Section 5. What should investors actually do?
Listen, if there is one golden rule you take away from this explainer, let it be this. Entering the Nifty 50 does not automatically mean BSE's share price is just going to keep rising forever. It is absolutely crucial not to trade blindly based purely on today's headline. Passive flows are one thing, but a company's underlying health is the real deal. And hey, the reverse is true too. Leaving the index doesn't automatically mean Wipro is a bad company now, or that its stock is doomed to fall forever.
Whether you own BSE, Wipro, or you're just keeping an eye on the broader market, you've got to look at the actual fundamentals. We're talking earnings, revenue growth, profitability, valuation, and their long-term business prospects. At the end of the day, these are the metrics that will dictate where these stocks are trading 5 or 10 years from now, long after the dust from this Nifty 50 shakeup has settled.
So to wrap this all up, BSE is moving in, Wipro is moving out, and it's yet another powerful signal that India's stock market is evolving at lightning speed, which leaves us with one pretty crucial question to ponder. As this market ecosystem continues to shift so rapidly, is your portfolio actually ready for it? Definitely something to think about. If you want more fast, structured updates breaking down major Indian financial news just like this, make sure you subscribe. Thanks for joining us for this explainer, and we'll see you next time.